It's a big week for central bank decisions, with the Bank of Japan, the Reserve Bank of Australia, the US Federal Reserve and the Bank of England all scheduled to make decisions. The wild card is Japan tomorrow, with an historic hike to 0.0% seen as very live. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, ANZ commodities strategist Soni Kumari analyses the outlook for commodities, especially now China's traditional demand for concrete and steel wanes and it ramps up investment in renewable energy.
This means that demand is going to slow down for traditional commodities while it will support demand for new commodities like copper, aluminum, nickel, and some of the critical minerals like lithium, cobalt, and other rare earth metals.
But first, in 5 and 5 with ANZ, the Reserve Bank of Australia is expected to hold rates when it makes its new once every 6 weeks decision tomorrow, as is the Fed on Wednesday night, and the Bank of England is on Thursday night. Here's ANZ Group Chief Economist Richard Yetzinger with the overview.
The RBA, the Fed and the Bank of England, all variants of the same recipe, if you like. The RBA, kind of the pressure on that central bank is to shift away from its tightening bias towards something which is more neutral. You probably see a hint of that this time, but we don't expect it to be a full shift. But probably by May there's a full shift. The Fed particularly will be that pressure to kind of keep dragging itself away from the easing expectations it's encouraged in the market because of the data we've seen, particularly recently, last week, for instance, inflation, but also some other numbers suggesting that the economy is not losing its inflationary bias as quickly as the Fed might have thought.
Number 2, the Federal Reserve's FOMC meets on Wednesday night to decide what to do with the Fed funds rate. It's widely expected to be on hold, but the focus is on guidance about the likely timing of a first cut. That'll be found in the famous dot plot. The last set suggested 3 cuts this year. Markets started 2024 expecting 7. However, it's now been wound back to be pretty much in line with the Fed. ANZ economist Bansi Madhavani expects a steady-as-she-goes decision and a dot plot.
We are not expecting any material changes to the current profile of a broadly moderating growth, gentle rise in unemployment, and a gradual return to inflation. One of the things that I would call out, which we would watch for, is whether the recent firm inflation readings will be sufficient to encourage a shift in dot plot. Our assessment is that inflation is still in line with FOMC's projections, and we see no compelling reason to alter that at this stage, but we would watch out for any potential changes in the Fed's dot plot for this meeting.
Number 3, the Bank of Japan could make an historic decision tomorrow to end decades of negative interest rates by lifting its policy rate to 0.0%. On Friday, the Bank of Japan got confirmation of the fastest wage growth since the early 1990s, which makes a rate hike possible tomorrow, or at the very least next month. Here's Richard.
It's really the toss of a coin about whether the Bank of Japan hikes this week or not. If they don't, we think there'll be firm indications that a move in April is likely. It's only likely to ultimately be a 10 basis point move, but it's kind of like the acorn that grows the oak tree, I suppose. It does have significance because of, this is the end of the world's longest negative interest rate policy.
Number 4. However, the UK economy is slowing down and a Bank of England cut is likely in August, says Bansi.
Our view is that, labor market is gradually rebalancing. We're seeing unemployment slightly tick higher. We're seeing wages growth soften. And our calculations are suggesting that if these trends continue, wage growth could fall close to 4% by middle of the year. The May labor market data and June inflation report would be available for the Bank of England to look at in its August meeting, which is why we think August remains the likely time when the Bank of England would start its rate cut.
Number 5. New Zealand is set to report December quarter GDP on Thursday, with the market consensus grouped around a marginal rise of 0.1%, and the Reserve Bank forecasting 0.0%. ANZ senior economist Miles Workman, he sees 0.1%. He says there's a risk that the GDP undershoots and New Zealand enters a technical recession. For the Reserve Bank, though, the focus will be on momentum in the services sectors.
Services are particularly important right now because that's a key source of upside inflation risk. And ultimately, for the Reserve Bank, if they are trying to induce a period of excess capacity in the economy, well, they're not really going to achieve that unless services industries play ball. So our expectation is that services industries' momentum does continue to soften.
Miles Workman there. Now, in today's bonus deep dive interview, ANZ strategist Soni Kumari surveys the outlook for commodities prices. China is all important.
In the latest National People's Congress meeting, they set the GDP growth at 5%, which is raising hopes for additional stimulus and monetary easing. So that remains important from market sentiment perspective. And as there is increased focus on renewables, electric vehicles, semiconductor, and also curbing carbon emissions, this will have diverse impact across commodities. Rare earth metals demand should benefit, while in energy space it will be positive for gas consumption because it is considered as a transition fuel. But in case of oil and coal, there will be negative impact on their demand. In addition to that, China has also pledged to prevent overcapacity in few industry, and this could curtail investment in copper, aluminum, and steel, which are energy and carbon-intensive industry. And this is again, positive for metals because domestic production will decline when demand is increasing. On the other hand, this means lower domestic demand for iron ore if steel capacity is being curtailed.
So just looking at this line that came out of the NPC, a move towards new productive forces, what does this mean, though, for demand for traditional commodities that China might be turning away from, and will others pick that up?
The NPC has highlighted increased focus on high-quality development, which is termed as new productive forces, and they are, focused on renewables, EVs, semiconductor, and advanced technology. And now it's very clear that China is moving away from infrastructure-driven growth to new sector growth along with accelerated pace in energy transition. And this means that demand is going to slow down for traditional commodities while it will support demand for new commodities like copper, aluminum, nickel, and some of the critical minerals like lithium, cobalt, and other rare earth metals.
So just talking about those structural changes in China, could you talk about the move towards renewable energy and what commodities that will drive demand for?
Energy transition is largely considered as metal intensive, and the increased focus on energy transition like renewables and electric vehicles are going to support metals demand like copper, aluminum, nickel, lithium, cobalt, and other critical minerals. And China has increased its renewable targets like solar capacity and wind capacity, and it's targeting to add another 395 gigawatt of capacity to be installed by 2025. We expect growth in solar generation to be at par with last year's level, which was quite strong. And something similar trend we are also seeing in wind capacity as well. The other sector which is going to spur demand for metals will be the adoption of electric vehicle, which is seeing an exponential growth. And government has been highlighting the importance of electric vehicle in energy transition. So these increased focus on renewables and electric vehicles will be supportive.
Soni Kumari there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Monday, March the 18th. Catch you tomorrow. We will look ahead in more detail to what the Bank of Japan's going to do. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.